Hello, everyone. I'm Marcello Sala, Head of Stakeholder Engagement at Apis Partners. Welcome to our first thematic thought leadership focused webinar, the emergence of the Internet of Value and blockchain as a value rail in financial services. We hope you've had a chance to read our recently released white paper on this topic and welcome any comments that you have. If you haven't yet read it, you can download it on our website at www.apis.pe. Before we get started, I'd like to provide some general information. Firstly, I'd like to confirm that this webinar is being recorded. As a webinar participant, you will be automatically muted throughout. If there are any technical issues you would like assistance with, please use the chat feature at the bottom of your screen and make sure that your message is directed to the host or panelists, not the audience. We would like this session to be as interactive as possible and are keen to respond to your questions. To submit a question, please use the Q&A button at the bottom of the screen. With that, I'd like to welcome today's speakers. Udayan Goyal is co-founder and managing partners at Apis. Udi has been a keen proponent of technology-driven reformation in banking and financial services over the course of a 24-year career focused on financial services. Prior to Apis, he was a co-founder of Anthemis Group, the first specialist global investor in fintech based in London. Udi and I are delighted to welcome our guest speakers, David Seymour and Matteo Dante Perruccio, to the webinar today. David is the CEO of Wave Financial, as well as the founder of Wavemaker Partners and Wavemaker Genesis. David also founded and grew Seymour and Associates into a leading boutique technology-focused investment bank before selling it to CEC Capital in 2016. He has been investing in cryptocurrencies since 2012. Matteo, a recent addition to our lineup today, is President International of Wave Financial and has spent over 30 years in various strategic and leadership roles across the asset management industry. Prior to Wave Financial, he was a non-executive director, board member, and global head of strategic partnerships at Jupiter Asset Management. And before that, he founded Hermes BPK Partners, a JV with BT Pension, as well as being a CEO of Pioneer Investment Management. With that, I will turn the webinar over to Udi.
Thank you, Marcello, and thank you everyone for joining us today. I think we hope to have like a very interesting and informative discussion. And before I get into both an interesting dialogue with David and Matteo, I thought what I'd try and do is give you a very quick précis of the recent white paper that we put out around the emergence of the Internet of Value and blockchain as a rail in financial services. And I think the reason this topic is becoming increasingly important is that, as many of you are observing in the financial markets in particular, there has been an absolute increase in the interest around crypto the amount of trading in crypto and the emergence of crypto as a real asset class alongside traditional asset classes, which is starting to become an important way of thinking about stored value, the usage of stored value, and ultimately I'll talk about something around what we call distributed finance. And all of this is going to be a changing paradigm as we go. So maybe if we could just advance to the next slide. So very quickly, I'm not going to spend too much on this, but most of you know we're a financial services VC and PE asset manager with pretty much global presence. We manage around $1.4 billion of AUM, and we are ESGI native, very, very important around the way we think about investments. And we're 30 people across multiple markets, including London, Milan, Singapore, Lagos, Nairobi, Mumbai, and now Cairo. And you can see some of our investments. So that's just a little bit on us. So if we move to the next. So I think what I wanted to do is put where we are in crypto with some context. And the context I'm going to use is actually by referring to a book by a lady who I know very, very well and I've supported over the years and collaborated with Carlota Perez, who is a very, very well-known academic in the economic space. And she wrote a book a number of years ago, which if you haven't read it, I do urge you to read, called Technological Revolutions and Financial Capital. Now, there is a theory that the world goes through multiple general purpose technologies, and every general purpose technology, whoever embraces it, actually becomes a superpower, or certainly has an increased element of economic growth. I think what Carlota brought to the table was the concept of how general purpose technologies and financial capital started to interact with each other, and actually identified 5 technological revolutions which resulted in significant economic growth spurts, what one could call almost a bubble, which then ended with a bust, and then the beginning of the next bubble, which was the next technological revolution. And those 5, not surprisingly, were the Industrial Revolution, the age of steam and railways, the age of steel, electricity, and heavy engineering, the age of oil, automobiles, and mass production, and finally, the age of information and telecommunications, which has resulted in our internet age. Now, in each of these phases, you had something called a eruption phase, a frenzy phase, a synergy phase, and then finally a maturity phase as you went through that. Now, the question mark is interesting, as we've been debating, is what is the 6th technological revolution? And I actually think it's a tricky one. It's a mixture. There are a lot of commentators that say it is artificial intelligence, and that is looking like the 6th technological revolution, which will drive us into this next phase of hyper growth. But I actually think the topic at hand today, which is the idea of blockchain and distributed infrastructure, is going to have a very significant similar growth. And actually, it's these 2 technologies together that are going to drive the growth in the future. So as you see here up in this particular slide, you can actually look at that same in another lens, which is how we move from the Web 1.0, which was really the beginning of digitization and the digitization of commerce in particular, to Web 2.0 as we got to social networks, using the mobile as a primary access tool, driving infrastructure into the cloud, to where we are getting to today, which is artificial intelligence-driven services, a decentralized data infrastructure, but using edge computing to reduce strains on bandwidth and constraints on bandwidth that you start to see. And so it's with this sort of lens, if we could move to the next slide, you start to think about, well, what effect does this have on the way we're going to do business in the future? And probably one of the most important areas is this idea of DAO. And DAO is this idea that we're moving into these decentralized infrastructures where no central legal entity or no centralized entity actually controls the way business is done. And this is very important because this is the first time we're actually going to be able to create an infrastructure which is decentralized, autonomous, and organizes itself. But most importantly, and this is the bit that, sort of certainly I got very interested in, is it's really the first time that we are creating an infrastructure that enables human coordination and machine coordination at the same time. So it brings together the concept of machines and humans all operating across a unique infrastructure, which is driven by a set of rules where everybody within that infrastructure can adhere to. And so that governance, essentially that governance system allows you to build systems and infrastructures which you couldn't do before in our traditional, for want of a better word, command and control infrastructure, the one that you see on the left here. Just moving on to the next slide. So that has had a fundamentally profound implication on the financial stack. I remember many years ago, we first started to talk about the disaggregation of the financial stack and likened it to, if you like, car manufacturing. So in the 1950s, General Motors was the largest manufacturer of cars in the world, and they did everything from extracting iron out of the ground, manufacturing steel, pressing the steel, making all the components of the car, putting it together, assembling it, and selling it through its dealer network. Today, if you think about car manufacturers, they're largely design and marketing entities, and some of them do the assembly, and everything else is pretty much outsourced. And what we started to see in financial services is that legacy stack starting to become stratified as you build APIs between different parts of the stack, and different people doing different things, including particularly the interface layer and the product layer and the application product layer. And we call those people fintechs today because they're using other infrastructure. They're using cloud-based infrastructure, balance sheet infrastructure. But I think the revolution is now coming on what you see right, which is this idea of the distributed finance stack, which finally removes the need for intermediaries in financial services. And removing the need for intermediaries actually removes a significant amount of friction that you may see as a result of moving around money and as a result of actually the intermediation of capital itself. And that's going to release a lot of efficiencies within the system, which then combined with what you're seeing with artificial intelligence, some of the other benefits of these general purpose technologies, could have a very fundamentally profound and interesting implication in terms of future growth. So just moving on to the next slide. So this is just to give you a little bit of an example. These are the different layers of the financial services stack and how they translate into the distributed finance stack. Some of these are protocols. These protocols are actually allowing people to build DeFi products that allow people to essentially borrow and lend using tokens. And you'll hear a little bit more about this in a bit, based on different rails, and some of the rails and infrastructure you see at the bottom. So each part, and what's interesting is there's a lot of investment chasing each strata, or each of these different parts of the stack, the interface, application, platform, and infrastructure stack. And this is really the revolution that's happening across the crypto world as money starts to chase these areas, and we start to build a real sustainable infrastructure that actually is going to deliver some of the efficiencies that I talked about earlier. So just on the next slide. And so I think that's broadly, that's a very, very quick précis of, I would say, a very, very, I would say, complicated topic, which I think we've done a reasonable job in explaining to you on the white paper. So if people have time, please do download the white paper. I think with that, I thought I would hand over to David to start off with, to give a little bit of an introduction around Wave Financial, what Wave Financial does. And I think you'll appreciate just how topical his business is at the moment. So David, over to you.
Sure, thank you. So Wave Financial is a asset management and wealth management firm around crypto. Screen jumping around. And we built basically two sides of our business. One side is a bunch of financial products, soon to be about 10, including things like index funds, 2BC funds, yield strategies, lending, kind of lending funds, cash management funds. On the wealth management side, we do kind of a lot of non-bespoke things. We work with a lot of high net worths to manage their crypto assets. We work with a lot of the kind of large crypto companies, which are mostly protocols in our world, that have very large treasuries, to help them manage their native tokens, their cash management, things like that. So Wave, is totally focused on crypto. We manage, I guess, a little less than $1 billion right now in the asset class. I found the company just 2.5 years ago, so it's been a pretty quick ride so far to get pretty scaled, which is kind of the power of being in an emerging space like this. And really what Wave was built to be when we founded Wave, which was back in kind of early 18, it was really born out of my own frustration of, I've been in the crypto space a long time, as Marcelo was nice to mention, my background, by kind of late 2017, probably had close to 100 different digital assets, tokens and things like that, which quickly became a small nightmare to manage. I hope to never figure out just how many tokens I lost. At the time, I probably had 25, 30 different software wallets I was running on different PCs, all sorts of treasures, like USB keys to hold assets. And just I'm wondering, this is became incredibly high time constraint to actually manage all those assets, let alone try to find new things to do. And really just kind of wondered why there weren't more wealth platforms in this asset class. So looked around and literally couldn't find one, so decided to go build one. So Wave, over the last couple of years, has become the largest wealth management platform in crypto, which we're not that big yet, but but the asset class is still emerging. And that's what we're doing here at Wave.
So great. So thanks both David and Matteo for joining us. Maybe my first question is just to give people a little bit of a flavor. So we have just been through a recent period of 5 or 6 months where crypto is sort of becoming the topic du jour pretty much every day. I want to just get a feel from you. Why is it that you've been in crypto for a long time, I think 10 years, something like that. Why is it that suddenly we are seeing this enormous interest in crypto? What's driving it? Why this interest and this increase in volumes? And basically, if I look and open the news every day, it's all about crypto. So give us a little bit of flavor of your views on why that is.
Yeah, it's been a slow burn. Like when we founded Wave in early 18, the market was at a time at kind of near all-time highs, which things seemed like everything was up and to the right, and then it wasn't. So crypto went through about a 2.25 year winter, as we refer to it, where asset prices did not recover back to where they were in the 2017 levels. But a lot of but the work of crypto never really slowed down. So even though asset prices kind of dropped, and I think a lot of at least the financial world kind of looked away from crypto in 2018 when Bitcoin went back down to 3,000 or so. The development really kept accelerating. And what really changed everything about 10, 11 months ago, the DeFi platforms, as you mentioned in one of your slides, really started to emerge and really started to work. What DeFi is, it's decentralized exchanges, it's lending platforms, platforms where you can get yield on your crypto, things like that. And that became, kind of fulfilled one of the big promises of crypto in general, which is this is a new way for, individuals, institutions, whatever, to approach finance, to manage their own assets, to generate income from their assets, things like that. And that really just drove, because those DeFi platforms actually work, even though the world was still pretty pessimistic on crypto, that a lot of companies started achieving pretty high valuations, which were quite justified. If you look at the kind of the Uniswaps and Aves of our world, Uniswap is generating somewhere around $25 million a day in transaction fees that are redistributed, which is pretty material amount of money. And Aave is generating, I think close to those numbers more on the lending side and things like that. So I think a lot of the early knocks on cryptos, I mean, I say early, not early for me, but early for most of the world, and they started looking at it, which was kind of 2017, is this is all speculation, nothing really works. Things had ridiculous valuations, which is obviously very true in retrospect. But then when the world kind of shifted and all of a sudden everyone could see, oh, these things actually do stuff, these things actually work, and that really drove a lot of excitement in the space. That was kind of what drove the beginning of this current bull run, which was kind of started towards the end of November of last year. And the bull run didn't start with Bitcoin, which was kind of a surprise. But if you weren't really deep in the space, most people didn't really notice. It was really a lot of these smaller DeFi applications and things like that really started the run. And then it kind of pulled up Bitcoin. And then once Bitcoin hit 30,000 and kind of doubled its old high, you saw the rest of the world start to wake up again. We've been in this space for too long. It's got hard to look at, kind of zoom out, I guess, to a 30,000 foot view. For someone like us that kind of lives and breathes all this. But we've all the large institutions we've been talking to forever, and Wave is basically built to be a bridge, for kind of non-crypto people to access crypto products, and then eventually, once they have access, get yield on those products and put them to work. We just kind of saw, all of a sudden all this demand, like clients that we were, prospective clients we've been targeting for years that didn't give us the time of day, were suddenly calling us every week. And people just kind of saw, there's a total shift in perception, and now this is real, and now it's back. And obviously pricing, obviously crypto is still a very highly speculative asset. So as pricing raised, and everyone kind of started to pay attention to this, and Bitcoin was back on the front page of Bloomberg every morning, and so forth, you just saw this huge kind of upswing in demand. And so the number of new people entering crypto has been just phenomenal. Every large financial institution is now in this asset class in some way. Kind of Goldman and Blackstone on down offer their clients crypto products. And that really started. I mean, all that really started in probably like April. Meaning like a month ago, was when we really kind of saw all these things kind of in the market. But they all did the work a long time ago. The biggest banks in Japan, like Nomura, started building their crypto custody solution back in 2017. So did a lot of other big players, but they just finally were ready to turn everything on. And there was finally enough kind of overwhelming demand from their clients that they didn't really have a choice to wait any longer.
So just picking up on one point you made, David, you mentioned DeFi, and I talked about DeFi earlier, right? So do you want to just explain to everybody the basic concept of DeFi, and then and one of the things that, and maybe explain one thing that I obviously I wonder about, which is if you look at, I don't know, Fulcrum, Nexo, Aave, any one of these products, why do they have double-digit yields? I mean, when you have the dollar basically at zero yield, why is this happening? Why is there such a big discrepancy?
Sure. So DeFi is simply decentralized finance. So what DeFi basically does at the most simplistic levels is exactly what everyone does in traditional finance. In crypto we call it CeFi, centralized finance. And so what decentralized finance means is, and there's two kind of main angles. One is exchanges, which are decentralized platforms, meaning they're software layers. I hate to use this analogy, but it's the one everyone kind of recognizes, is like Napster. They're building a decentralized platform for trading, for lending, peer-to-peer transactions, things like that. And it's pretty simple in concept, but incredibly powerful how it actually works, and how quick it is, and how it turns out quite easy it is in some ways to build these kind of platforms. And what they just, all they're really doing is just eliminating a lot of middlemen. So I mean, the power of like a decentralized exchange is, the fees are incredibly low relative to a centralized exchange. Coinbase charges 1% per transaction if you're not on the pro side, which is onerous. Decentralized exchanges charge, 0.000%. Because it's just software and there's no team, it can be very efficient, and everything kind of works peer to peer. So that's all really decentralized finance is. Now it crosses into a lot of legal quagmires because it's touching money, and there's things like OFAC in the world and whatnot. Anyway, so that's what DeFi is. And I guess, what was the second part of the question?
The second question is just the yields. Why are the
Right,
yields where they are? I mean, on these different, on all of these different products.
Yeah, so the yields are incredible. Just to give people some context, we're launching a new fund product in our world, which is just a cash management fund. We're launching two versions of it. The conservative version is a 100% collateralized in Bitcoin, fully secured, relatively, very, very low risk fund. Even with those properties, it still generates about 8% a year, which is very high to say the least. Now, if you go into DeFi realm, which is the second cash management fund we're launching, even staying crypto market neutral, though obviously there are some platform risks, we're pretty easily hitting about 50% IRR, which is just pretty incredible. That is using leverage.
Sorry, 50 or 15?
50.
50. Okay. Just.
So it actually, 50% IRR, and that's using about 3x leverage. And that's leveraging a lot of different platforms. So I'm not going to say it's riskless to say the least, but it's it's crypto market neutral. And those are kind of the things you can achieve in crypto right now because there's a huge lack of liquidity still in this asset class. So there's two elements to why yields are so high. One is there is this need for liquidity. There's a lot of simple trades that are very used in the crypto hedge fund world, which we call mostly cash and carry trades. You can kind of short the spot and buy the future, and there's kind of like if you repeat that through cycles or do it in perpetuals or whatever, that alone throws off like a 15-20% yield, just because you're basically funding futures markets. There's a huge need for lending. So a lot of the asset managers in crypto, we're not one of them, but a lot of them do mostly market neutral strategies. Of course, to do that, you have to borrow assets. Usually you're borrowing like Bitcoin or Ethereum and shorting it, and you're going long on other assets. So there's a huge amount of demand. So naturally, the demand is actually quite high. So if you ignore kind of the DeFi aspects, which I'll go into in a second, just looking at borrowing, crypto or borrowing fiat, the typical rates from the borrower side are anywhere from 10 to 15%. And obviously, there's a lot of counterparty risk in that and things like that. And those are mostly over collateralized loans. So there actually is that much demand. Then in the DeFi world, because this is a token world and everything's a little bit crazier in crypto, you still have those same rates. If you want to, if you have cash to lend into a DeFi platform and you want to do nothing funky with it, you'll get 13, 14%. Now, if you want to do, some kind of interesting like liquidity, pooling and mining and things like that, it pretty quickly ramps up. So you can in DeFi world, because how the DeFi world works, and this is the very non-sustainable part, is a lot of these companies are token based. They distribute their tokens to users. And they have a large amount of this token supply. So they use their own protocol tokens to kind of buffer the interest rates. So like right now, Aave, which is one of the biggest, it is the biggest peer-to-peer lending platforms, a partnership with Matic. So if you take out a loan, Matic has a lot of tokens. They will give you additional tokens from Matic's treasury to bump those rates up. So right now, for cash lending on some of these platforms, just without leverage anything, you're seeing like 23, 24%. Which is a pretty highly incentivized lending model. So they're giving away their treasury tokens to do a land grab.
They're buying liquidity. Is what you're saying is they're buying liquidity in effect.
They're using their own token treasury because they made up a currency and they have lots of it in most cases. They're using their own currency to put higher rates in as a way to distribute tokens to more users, but also as a way just to get more kind of access into this market. So that part will end pretty quickly, like not super quickly, probably in the order of like 1 to 2 years. But the demand for liquidity is not going to go away. There's there is not enough, kind of cash around this asset class. So the yields are very, very high, which makes it fun for people like us.
Uday, I wanted to, if I could just go back to your original point, one other point I wanted to add to what David said about why I think this is really taken off more recently, the whole crypto conversation. I think one of the observations that I noted was that this is, in my personal career in asset management, the first revolution in financial services that started at the retail level. And because generally most innovation starts at the more sophisticated investor level and then filters down into finally mass market. And because of that, I think there was a certain degree of, forgive the indelicate term, but a bit of social Darwinism that took place in the first run up of Bitcoin. and the institutions needed one thing that David mentioned. I think that took a bit longer than people expected, which was safe custody. Institutions could not put their capital at risk like retail clients were willing to. And so once that got solved, and it got solved pretty rapidly, and now we see the entrants like Bank of New York and Standard Charter and all these other, major bank names come in as custodians. That was the last sort of obstacle to drop for institutional money to come into the market. And then of course the bellwether for news and press are, the Goldman Sachs of the world, the Morgan Stanleys, the JP Morgans. And so now that they're entering, I think, it's sort of the validation for everybody involved that this is here to stay and it's going to continue to grow. Adding to what Dave said.
So on that point, Matthias, let's add two thoughts to that, and be great to get your views. One is regulation, and what is the impact of regulation in terms of making this a mainstream asset and mainstream adoption of this particular asset class, and obviously within that maybe focusing a little bit around some of the more tricky ones, which is the KYC and the AML issues that are emerging, and some of the question marks that are coming up out on that.
That's a really, actually I was thinking about it on your graphic, on your presentation of that sort of decentralized model where there's no longer, and how technology is evolving at such a velocity, and regulation in the best of times tends to evolve very slowly, right, and cautiously. And so the biggest unknown and the biggest challenge for regulators is how to regulate without killing this innovation, what's good and bad about the innovation. And I think the area that so many people focused on originally is probably, this may sound counterintuitive, but I don't think that the know your client and compliance part is going to be the biggest challenge. The reason I say that is because RegTech is evolving super fast, and with blockchain, it's evolving alongside a lot of the development in the crypto space. I think the challenge is it might be philosophical because some of the let's call it the hardcore crypto enthusiasts, refuse to accept the idea of any sort of governance over the infrastructure, right? So there's this natural tension. But I do think that unfortunately, I think regulators tend to be like most, I guess most of us, when new inventions come, we tend to want them to look and smell like the thing that came before we really make the full jump. The car looked like first car was a motorized carriage before it became a car, right? So I think regulation will try probably and be a bit clunky in this interim period, but I think the bigger markets, the bigger capital markets are realizing that it's requiring, dramatic change in the way they're looking at the financial markets to regulate this. And so I'm not overly concerned. I'm sure there'll be some missteps and some mistakes, but certainly we're encouraging the U.S. With some of the new people that have arrived and their understanding of the sector. So yeah, I don't know if that answers your question.
And then maybe related to that, one of the other question marks that's been arising is taxation, right? So you have an asset class which, in some places, doesn't really fit into any mold of traditional financial instruments. So how do you think people are thinking about taxation across the world?
There's is that for me or for Dave?
For either one. Either one of you.
I can speak a bit more to Europe. I'll let Dave speak more to the US and how he sees it evolving. In Europe, we still have, I know the European community and the Commission and so on are working on regulation to try to find some homogenized approach to this. But up until now, we have country-specific approaches to it. And it's such a big subject because it depends, especially when you get DeFi into the conversation. When you're talking specifically about cryptocurrencies, it's somewhat simpler. It's a question of how do we define them, and then are they capital gain, are they income, are they currency and commodity, whatever, and they define it and then they tax it. The only thing I can say with absolute certainty is it will be taxed. How? I'm not quite sure, but they will find a way to tax it, everything. But yeah, so I think the DeFi part of it, these yields and this income being generated over the DeFi platforms is going to be a greater challenge for fiscal authorities across Europe, because there's no easy point of entry and point of exit to apply the taxation policies. At source sort of philosophy that exists today is not going to work. So they're going to have to figure out more philosophical approaches. I don't know, David, if you agree or.
Yeah, I mean, to the regulation point, it's a there's a lot of challenges around regulating this asset class, and obviously how regulation is kind of ordered is very top down. There's no such thing as DeFi to a regulator. We are regulated. We're a registered investment advisor in the U.S. And we talk to the regulators a lot, not that we want to, but we kind of have to. And the whole premise of crypto is just so foreign to them. Like the whole model is, okay, from a regulator point of view, is someone did something wrong, who do I kill? Like, who is supposed to be supervising him? What are the written procedures? How does that flow up? Who can I issue a penalty to if something wasn't supervised properly and whatnot? So even from your chart you put up a while ago, you have these DAOs, decentralized autonomous organizations, and you have this kind of source code that's just put out into the world, which is leading to decentralized exchanges and lending and finance. That model doesn't work. Now, from a regulator world, we talk to them a lot. They feel no need to change. They think their regulatory model is proper. This is what they're built around and have been doing for 100 years. So they're still trying to find ways to force down kind of a centralized hierarchy onto this asset class. And that would be really interesting to see which way that goes. One of those things has to give. Either the regulators have to get more comfortable with the way decentralized finance works and blockchain works, or they just start trying to outlaw things and things like that, and to say, like, we don't believe a decentralized exchange can exist. It's not licensed. It can't do OFAC. There aren't all the usual protections, for consumers that they would want to see, like in a banking license or something. So no one really knows how this will end. It is by far the biggest topic people like me that live in crypto kind of focus on. Just how will this end? Now, the biggest stick they probably have from regulator side, which is is taxation, as you said. So that we're seeing, for a long time, a lot of countries, like probably, kind of led by South Korea, which, is why we still have a kimchi premium. Meaning kimchi premium means that, Bitcoin, if it's, $56,000 in the US, it's probably $62,000 or $63,000 in Korea. Kind of all else equal. And you see that persisting because there is no taxation explicitly of crypto in Korea. So the government, not intentionally, gave people a huge reason to play in the asset class by making it tax advantage. Now, obviously, that's ending pretty shortly. There's already legislation proposed. And what we're starting to see from a lot of the first world countries that are not super crypto positive, which is most of them, is using taxation as a stick to kind of slow down kind of crypto innovation and slow down a lot of these platforms. So we're actually seeing kind of, as opposed to just looking at these things in the US, like capital gains, there's a lot of proposals to make everything in crypto ordinary gains, which is obviously a little punitive. It makes that a lot less exciting to go speculate on these assets and whatnot. And if they make them, much higher taxation effectively than in a stock market asset or something. So we'll continue to see that. I mean, no one really knows where this is going to end. But as Matteo said, there'll definitely be taxes.
We've had this massive bull run, right, over the last, 3 or 4 months. So theoretically, a lot of people like you and others are sitting on massive gains. And at some point, for example, in the United States, the IRS is going to tax you on those gains. And in order to get those, in order to pay those taxes, you're going to have to swap some of your crypto into US dollars, right? So, and in a market where liquidity is tricky, how exactly is that going to play out? So
Yeah, I think there's going to be a hangover. It'll have an impact on the crypto markets for sure. We saw this, in 2017, we had this great run up, which great for people that were in it. And I sold a lot of Bitcoin at like 15, 16,000, which was great at one side and generated a lot of taxable income, a lot of it short term. And then obviously, come March, when people were trying to figure out how much taxes they had to pay in April, we saw the market just absolutely crater. That was March alone was like a 60% down month, which is, and I think set a record for almost any asset class in 1 month. So you saw this huge unwinding, and it was very painful, even for people like me that have a lot of other assets outside of crypto. It was, you're kind of forced to sell more Bitcoin at like $5,000 and things like that, because you just had this huge taxable bill, and what are you going to pay it with? And that was a vicious cycle, because as the asset classes got, as this asset class went down, people were selling, so they had to sell more and more individual assets, to raise the same amount of capital. So I think we'll see something a little bit similar in probably early, end of this year. We'll see some tax planning selling, which you always see in stock markets or any markets. That doesn't really worry me. What worries me more is, as a lot of these kind of retail investors who aren't very forward thinking, and every cycle we see the same thing. Come March of 2022, I think we'll see a lot of forced selling, where people realize, wow, I did make a lot of money in crypto. I generated this huge tax bill. Now I've got to service it. So I think March is kind of when it always comes later than it should. I think March is when you'll see a lot of kind of forced selling. Now, I also think the market will be considerably higher by then. So what exactly does that mean? I mean, it'll probably be a divot month, and for financial investors, it's not something we're really trying to plan around very hard. For our own financial products, like I think it'll pass pretty quickly. I don't see a repeat of 2018 where we see an 80% decline in asset prices. I think it'll be a little more modest.
Uday, can I just add a point there? Because I agree with Dave, but I think I just put a different perspective. I do think one thing that we're not entirely sure about, that will not mirror what happened in the previous markets, is the level of institutional money. As we know, large institutions, and a lot of this depends on what happens over the next 12 months, how much really comes in from pension funds, endowments, the longer term investors, where that money is not as hot. It's not, the tax planning and fiscal planning is of a different nature and dimension. So I think that's a really interesting thing to watch for, is how that affects these dynamics. The market will get deeper and bigger as that happens, to see how much effect it has on the values and so on. But just wanted to add that point.
Yeah, no, that's a great point. In fact, but that largely depends on the large global custodians having crypto as one of the products that they do custody for. So I think you see that with Fidelity, and a few others, but it hasn't become universal as yet, right? We're still waiting for that to happen. Presumably that has some impact on your own asset management strategies, right? And how you think about building your own products.
Sure.
Yeah, I mean, so there's kind of the trend in crypto was, we kind of start the whole world right now, from like the Goldmans and kind of BlackRock's on down are really focused on access products, as we refer to it. So people want crypto, so let's give them a high fee vehicle. In some cases, we see like 2 and 20 funds emerging, even from like JP Morgan, that literally hold Bitcoin. So it seems kind of odd that people would try to charge 2 and 20 on a single asset index. But if you can get away with it, great, if you got the distribution. And then anyway, so the access, you kind of call it land grab, is getting pretty intense right now. Like, I mean, literally almost every financial institution I can think of, I shouldn't say every, but 70% of them are trying to build access products or give access to their clients. So that'll be, for our asset class, that is great. I mean, if they even if a couple of those just turn on the spigot full steam, it will attract hundreds of billions of dollars in cash, and those people have to turn around and buy hundreds of billions of dollars of Bitcoin and Ethereum, which should be pretty powerful in moving the market. The asset class isn't that large yet. It's $2.5 trillion. So we think that's really it's going to be a huge driver over these next, call it 9-10 months, as we go into that tax season. And then, as Matteo was saying, you're just going to see you're seeing a lot more support. Like, crypto's been very volatile. I think I did sit down at one point, that wasn't even that recently, and figured out that I'd been through, I think it was 70% asset crashes in 10 years. But in 22, I think I figured out this probably needs to go up 50% crashes. And I started counting the 30% crashes I've lived through, and I got to like 80s or something, and I gave up trying to count them all. So we're used to the volatility in this asset class. You're actually seeing a huge reduction in volatility already, which, if you watch the crypto market kind of daily, it doesn't seem like it, because it's up 7% or down, on individual days pretty often, which seems pretty huge. And compared to historicals, is not huge at all. Like, the last crash, quote unquote, where the market went down about 30%, which was, weeks ago. And I'll get all these emails from our clients like, oh, are you worried? Is this the end? And I'm like, you guys got to be kidding me. Like, this is nothing. Like, you weren't here in the dark days, 85% drops weren't that uncommon. But we're just going to see, but with this institutional demand, and it's, it already is very real. Like, we're just seeing, tens of billions of dollars, pretty much weekly going into stronger hands, institutional hands. And that's only accelerating. I mean, Goldman's products aren't even ready yet. They're probably going to go live in 2 weeks. Fidelity was one of the first ones in the space. And they've already gathered, I think, 25 billion or so in crypto assets into their custody platform at least, and things like that. But it's accelerating so fast.
Yeah, you've also got like Morgan Stanley, who's made some big commitments to develop out their crypto proposition. I mean, another observation of the health and the evolution of this is changing from what it used to be is the the market cap weight of Bitcoin in the overall cryptocurrency world. People I don't think people have talked about it enough. It's down to like 42, I think 43%. Down from, I don't remember what the highs are. You know better than I do, David, 90 something percent, I think, at one point, and then it came down. So, that is to me a very healthy sign. And it's not all healthy. There's some stuff that's skewing that within there that we know about, and Elon Musk and others. But all in all, I think it's a very good sign that the market is broadening, widening, and deepening. And there's more participants and more intelligent and more sophisticated investors coming in now.
And then do you both think that we're going to get a significant increase in the ETF type product as an access product for crypto? Because that, to me, allows a more mass market participation in this ecosystem?
Yeah, I think that's going to be huge. Obviously, Canada kind of broke the seal on allowing the first ETFs, which they fought as hard as they could, like multi-year lawsuits from several companies to try to stop them from launching crypto ETFs. And then once the first couple, or even closed-end funds, once the first couple launched and quickly gathered several $1 billion, suddenly everything changed, and then the TMX and the OSC and regulators and whatnot are like, oh, this actually is great. So we're working on launching a couple of those products ourselves in Canada. We're also working very closely with one of our partner companies in Singapore, launching a couple of specific ETFs in that region. There'll be first is a Bitcoin one, of course, which will be the first one in all of Asia. So we're pretty excited about those projects for ourselves. And I think that'll definitely kind of democratize access a lot better. It is difficult right now to acquire crypto for most people. I use like Goldman for private wealth and things like that. And I do kind of ping them every now and then saying like, hey, I want you to hold my crypto. Not that I actually do. I just want to see what they say. We hold crypto just fine. And they're finally there. Like, they're finally now saying, yes, we've got these products coming. Give us, 4 weeks was the last time they said, about a week ago. We're going to have bespoke Bitcoin funds that are private funds, not ETFs. But the access is really there now. So I think the ETFs will be a huge, spur of this. They will gather a lot of access. But even without the ETF world, the numbers, depending on how you look at the numbers, it changes a little bit. But there's somewhere around 3 or 4 million new Bitcoin wallets being created each day, which is, is a lot. There's somewhere, if you look at, if you kind of basically try to duplicate things, there's about 180 million crypto wallets currently in the world. Which isn't that many, but it's not that few either. This is one of the metrics we actually watch really closely, and that number is going up. You go beyond Bitcoin, you're probably about 4 or 5 million a day. So I mean, by the end of this year, we should be seeing 3, 4, or 500 million people that own this asset, or
but largely concentrated, because I worry sometimes, like somebody like a Coinbase, has a very huge concentrated part of that market, and is that a single point of failure for the market?
It is. I mean, Coinbase is, and by trade volume, by actual dollars, they're actually not that big of an exchange. They're just a very known exchange. Their volume is less than a tenth of Binance's. Like on the org chart of daily trade volume, Coinbase is like number 12. So yes, they're big and they have a lot, and obviously they're in from a revenue side because their fees are so high, they're very big in our world. But yeah, yes, there are a single point of failure, but this is a new industry, so I don't really. A lot of people do worry about that. Like in Coinbase's software, quite frankly, is not very good. Like their exchange, kind of goes down all the time. Every time there's a big spike in Bitcoin or a big crash in Bitcoin, all of a sudden all the trades slow down. Like the platform really can't handle the volume, and obviously they're trying. So there are a lot of systemic risks around this asset class. So one of them is it is very kind of exchange dominant, and those exchanges are all relatively new. Again, like this hasn't been a very large asset class for very long. But it doesn't really worry me a whole lot. I mean, I was an internet guy, starting in VC back in '95. Like I was one of the early, not early, but very early users of like E-Trade and things like that, like online trade. And they were terrible then too. If you had the misfortune of trying to use those platforms back in the early '90s, or mid '90s, they were awful. I mean, it was, it always didn't work, and login problems and trying to move assets around. It was pretty painful. And then, but in 5-6 years or so, they went more mainstream. They got really good. So we're kind of seeing the same thing in this asset class. As far as a point of failure goes, I mean, I don't see them as a systemic point of failure from a custody standpoint, which would be like a massive failure, like if they actually got breached. I had the pleasure of being around it during the Mt. Gox days, which was the dominant crypto exchange / custodian, which basically burned to the ground in kind of early 14. And that was rough. I didn't even have any assets there, but it just took everything down, when that one failed, because it was 80-90% of the market. And no one has close to that now. Like, Binance, which is the largest exchange, I think is closer to 10% of the market, which is, a lot. And it'd be bad if they imploded in some fashion or had a technical issue or whatnot. But I wouldn't see it bringing this whole asset class down. And asset class is so broad now with, hundreds of millions of holders and lots of, kind of different custodians and banks coming and everything. I don't think any one point of failure can do that much damage today.
Very good. I have a question that came in, from the audience, which is it anticipated that any types of fintech companies, and the examples they say payment networks, remittance, may need to adapt proactively to what's going on with the crypto market, the changes in regulation, or is it really too early to call?
So, I mean, most of fintech companies are obviously focused on crypto. I mean, if you look at the largest players, I mean, PayPal and Square and all the different, kind of more advanced, fintechy payment rail companies have been allowing people to buy, trade, hold crypto for at least 6 months now, for longer in PayPal's case. So we're already seeing that. I mean, the integrations are everywhere. Sotheby's is doing crypto offerings, but also allowing people to pay for anything in Bitcoin or Ethereum now. And things like that. So you're seeing, the rails have been pretty well built, and I don't see, that is a real challenge anymore. I mean, I think crypto pretty rightly kind of dominates a lot of fintech discussions, because it's just where most of the interesting things are happening. Like it's hard to be, a fintech focused VC and not be spending a lot of time paying attention to this asset class. And kind of working in this asset and things like that. I mean, it's just, there's just too much money floating around. There's too much innovation, but this is going to change everything. I mean, you mentioned, I think it was maybe in the slide portion of this presentation about the waves of technological change and whatnot. And, I think AI is a big one also. But I don't think, it's a question of, is it AI or blockchain that's going to be the sixth revolution? I think it's much more of an and. Like all this decentralization and then AI, which comes into automation and autonomousness and everything else, they're definitely playing together. A lot of what's going to happen is you're going to have these decentralized platforms and you're going to have AI robots, kind of operating in them, and you already have lots of AI trading in crypto, trading in other asset classes, trying to, automate different aspects of things. And it's just going to accelerate so much faster. It's already here, but the sixth revolution is pretty obvious. I think anyone paying attention.
So I just had another question come in, which is, what is your view of the evolution of security tokens and the role they can play in mobilizing capital towards companies via smart contracts, i.e. claims on cash flows?
Yeah, we're huge believers in digital securities. We're also regulated. Our first business model was, or this is going back to early 18, which doesn't seem that long ago to some people, seems like an eternity to us, was that we were going to build lots of digital security products. And then we quickly realized, okay, there's no demand for digital security, like tokenized funds and tokenized assets. The interest in talking about it was very high. The interest in actually investing in it was very low. This is going back to like 2017. Now we're finally seeing all that change. We launched a whiskey fund, I guess about a year ago now, which is a whiskey aging, fund that we're tokenizing. We'll throw it on exchanges. It's kind of a cool way to give people access to a very unusual asset, aged whiskey barrels. So you can actually have soon be able to have a market neutral whiskey habit, which we think is kind of cool, or, things like that, making these things tradable. Obviously, there's a lot of work done across real estate, real estate's obviously a massive asset class. So everyone kind of assumed rightly that would be the first one that will gain a lot of adoption. And it is, though it's been much slower than people like me expected. People like me that were talking about digital securities back in 2015. We all thought it'd be here a little sooner. I think there's a couple of huge themes in crypto that everyone kind of oscillates to. One is store of value, which is like Bitcoin. One is another one is like DeFi and decentralized, and finance, which is a big one. There's and then there's kind of NFTs / what I consider like digital security funds, and I usually put them in kind of the same bucket. Not entirely. NFTs are non-fungible tokens, which is a terrible acronym, but anyway, it just means like collectibles, unique things, having unique identifiers, digital, kind of digital identity and things like that. And combined
actually extends to art and things like that, as we saw very publicly, right?
Yeah, NFTs is a huge theme we are spending a lot of time in also. But anyway, so getting back to digital securities, we do see the world's assets being more and more fractionalized, and blockchain seems to be the best way to do that. So what we mean by that is there's been this massive path towards more liquidity for the past couple hundred years. It started with the kind of bond bank debt markets in the 1800s. Then we had the stock markets. Then we had derivative markets. Then we had REITs around real estate and derivatives. And as you kind of look forward, there's always been this path towards more liquidity. That's been like the dominant theme of finance over the last 100 years is people want more ways to hold things as financial assets, the rise of commodities. In the early 80s, no one thought anyone would actually care about commodities. And so none of the big banks even had commodity desks. Then a few of them started buying them and people started realizing, okay, this is, and then of course in 5 years, everyone had a huge commodities practice. We're seeing the same thing in this asset. So one, you see that with like Bitcoin and everything, but I think you're going to see a huge, the easiest way right now to take more bespoke assets, think like a commercial real estate building or a, $50 million piece of artwork, is to tokenize it, fractionalize it on that platform, create these digital certificates, let people buy them. It's a theme right now that's gaining a lot of steam finally. Like a lot of us thought it was going to be 3 or 4 years ago. So we got a little burned in that respect. But yeah, no, I think that's a huge part of the future of this asset, or of all asset classes. Now, having said that, the regulatory problems around it are huge. Creating these products in a Reg D, Reg S world using US parlance, or proper fund structures and things like that is really, really difficult, and we haven't solved most of the problems there yet.
Yeah, it's. It reminds me of obviously something that we always say, which is we tend to overestimate the effect of a technology in the short run and underestimate its effect in the long run, which is exactly what you're saying. I think just in the last few minutes, I'm going to ask Matthias that there's a question that just came in, which is, I think the $1 million question, or maybe the $1 billion question, which is, when will crypto become a globally acceptable means of exchange and replace the US dollar as the global reference currency?
I get that question. Well, here's my answer to that. I never say never, but it'll be a long time. I think it's much more likely that Bitcoin will become perhaps the international currency of trade and trade finance, which will replace the dollar in that respect. For a whole host of reasons, and the American government is partially responsible for that with its fiscal policy over the last 10 years. But I could see, we're creating a global infrastructure based on blockchain, and it's only logical to me. Countries are all, for that reason, all scurrying to figure out ways to create a digital currency. The U.S. the U.S. is doing it, but China's done it, and lots of other countries are doing it, partially in order to stave that off. But I think if Bitcoin continues its upward spiral and continues to have, the one beautiful thing about it is it won't have inflationary, because its finite nature will not have the inflationary characteristics of other printable currencies. So to me, it makes it an ideal currency to use for trade. So that would be my answer. But governments have a lot of power to slow things, and they have a lot of power to impact the way these things evolve. But you can't stop a wave, right?
Yeah, David, do you have a prediction on that?
Yeah, my answer is a little more, I guess, crypto bullish than Mateo's. As you said, I think things, in the short term, short term being like a year, yeah, not much is going to happen, but we continue to see this asset class gain a lot of adoption. My own view is probably closer to like 5 years. I think we'll actually see a real tipping point. And I think it'll be really sudden. When these things kind of happen, they always happen very fast. It's usually not, there's usually kind of a slow trickle, and then everyone kind of agrees collectively, this is probably the future. And I don't know exactly which coins or which tokens will be the foundation of it. It's fast. All these government-backed coins, coming out of China, and now there's about 50 countries issuing, their own currencies on a blockchain, which is, at one level fascinating because it's going to drive huge awareness. Like, the Chinese are teaching their populace that blockchain-based, money is a good thing, and it's a viable thing, and you should trust it. The unintended consequence of that is, that everyone's going to start trusting it, but they're not going to want that currency. The whole reason for Bitcoin to exist, after the 2008 financial crisis and whatnot, is we don't really trust the governments very well. Like, the purchasing power of a US dollar over 50 years is down like 85% or more. So that's lousy. It's holding dollars is actually a pretty lousy asset. The inflation is far higher than anyone prints. So I think the education that's going to go into all these coins, and there's going to be, and it also, as soon as you go to digital government currencies, it makes it far, far easier to flip those currencies into things that aren't, inflationary, like Bitcoin and things like that. So I think there'll be a huge shift at some point in the next 5 years where people look at these different monies and say, why do I think of the world in dollars? And you're a US citizen. Like, why, and in my own evolution of this, I've already kind of reached that point. Like, I was buying a new car, a Tesla, and I was like, man, 2 Bitcoin? It's pretty expensive. And that's how people in our industry kind of start thinking. Like, it's just, not on everything. I don't think about that when I'm buying a cup of coffee. And I think there'll always be a place where fiat will still be the dominant kind of tradable currency, or fiat denominated amounts will be in, and I don't need to purchase a cup of coffee on it and have it recorded forever on a nuclear grade, Bitcoin ledger that'll survive, that 10,000 years. So there'll be some, I guess, kind of, diversification there, but I do think there'll be a really big tipping point in the future where people say, yeah, if I'm going to hold powder, I'm going to hold a, kind of a fungible asset in anything, it should be in something that isn't inflationary.
Fantastic. Well, perfect timing. We reached the end with the $1 billion question. I wanted to take this opportunity to thank you both for spending the best part of the last hour with us and getting your insights. Super excited about Wave and what you guys are doing. And obviously from our perspective, we think this is right at the cornerstone of the future, building out the asset management industry for crypto. And that's going to be an important part of market development. So congratulations both on, what you've built so far, and, all the best of luck for the future and for the future of the company. And thank you very much again for joining us.
Thank you.
Thank you. Thanks for having us.
Pleasure.